Major stock market crashes. Investing in the stock market can be an exciting and profitable venture. However, with great reward comes great risk. Throughout history, there have been several instances where the stock market crashed, causing widespread panic and financial devastation. The following are some of the most significant stock market crashes that have occurred around the world. The Wall Street crash of 1929, the Black Monday crash of 1987, the Japanese asset price bubble burst of 1990, the Asian financial crisis of 1997, the dot-com bubble burst of 2000, the global financial crisis of 2008, the flash crash of 2010, the China stock market crash of 2015, and the COVID-19 market crash. The Wall Street crash of 1929. The Wall Street crash of 1929 was one of the most significant events in modern economic history. It marked the end of the Roaring Twenties, a period of unprecedented economic growth and prosperity in the United States, and the beginning of the Great Depression, a decade-long period of economic hardship and social upheaval. The causes of the Wall Street crash are complex and multifaceted, but at its core, the crash was the result of a speculative bubble in the stock market. In the years leading up to the crash, investors had poured billions of dollars into the stock market, driving up prices and creating a sense of euphoria and optimism. But this optimism was based on little more than blind faith and speculation, and, when the bubble burst, the consequences were catastrophic. The crash was caused by a number of factors, including overspeculation in the stock market, which led to inflated prices, a decline in consumer spending, which led to a decrease in demand for goods and services, a rise in interest rates, which made it more expensive for businesses to borrow money, and a decline in agricultural prices, which hurt farmers and led to a decrease in demand for manufactured goods. On October 24, 1929, known as Black Thursday, the stock market experienced a sudden and dramatic decline in value, triggering a panic among investors. Over the next several days, the market continued to plummet, wiping out billions of dollars in wealth and leaving millions of investors destitute. The stock market lost over $30 billion in value, which is equivalent to over $400 billion today. Millions of people lost their jobs, homes, and savings. The Great Depression also led to a decline in international trade and a rise in nationalism. The crash also led to a number of reforms in the financial industry, including the creation of the Securities and Exchange Commission, SEC. The Black Monday crash of 1987. October 19, 1987, also known as Black Monday, is the day the U.S. stock market experienced its largest one-day percentage drop in history. The Dow Jones Industrial Average plummeted 22%, erasing $500 billion in market value. To put that into perspective, that is equivalent to $1.2 trillion in today's dollars. The crash was so severe that it took 2 years for the market to fully recover. The crash also caused significant declines in stock markets around the world. There are a number of factors that contributed to the Black Monday crash. One factor was the use of portfolio insurance, a trading strategy that involves selling stocks when prices fall. This strategy can lead to a self-fulfilling prophecy, as selling can cause prices to fall even further. Another factor that contributed to the crash was the use of computer-driven trading. Computers can trade very quickly, and this can lead to a rapid sell-off if prices start to fall. Other contributing factors include rising interest rates, falling oil prices, and a weakening US dollar. The Black Monday crash had a significant impact on the global economy. It led to a decline in stock prices, a decrease in investment, and a rise in unemployment. The Japanese asset price bubble burst of 1990. The Japanese asset price bubble of the late 1980s was at its peak in 1990. The value of land and stocks in Japan was estimated to be worth over 4 times the entire US GDP. Japan was caught up in a frenzy of speculation and excess. As the economy boomed in the 1980s, investors poured money into real estate and stocks, driving up prices. At its peak, the price of land in Tokyo was estimated to be worth more than all of the land in the United States of America. The Japanese asset price bubble was the result of a combination of factors, including deregulation, low interest rates, and speculation. The bubble was characterized by a rapid acceleration of asset prices and overheated economic activity, as well as an uncontrolled money supply and credit expansion. More specifically, overconfidence and speculation regarding asset and stock prices were closely associated with excessive monetary easing policy at the time. In 1990, the Bank of Japan raised interest rates in an attempt to cool down the overheating economy. This had the unintended effect of bursting the asset price bubble. As prices plummeted, investors who had borrowed heavily to invest in real estate and stocks found themselves underwater, unable to repay their loans. The fallout was devastating. Banks and other financial institutions that had lent heavily to speculators found themselves with large amounts of bad debt on their books. Many people lost their jobs and their life savings. The burst of the bubble also had an impact on the country's culture, as people had to adjust to a new way of life that was characterized by economic hardship. The bursting of the asset price bubble had a number of negative consequences, including a decline in investment and economic growth, a rise in unemployment and bankruptcies, a decline in consumer spending, and a decline in the value of the Japanese yen. The Japanese government attempted to prop up these institutions with massive bailouts, but the damage had already been done. The Japanese economy would spend the next 2 decades mired in stagnation and deflation. The effects of the bubble burst were felt not only in Japan, but also around the world, as the country's economy was closely tied to the global economy. The Asian financial crisis of 1997. The Asian financial crisis originated in Thailand, where the government had been borrowing heavily to fund infrastructure projects. The country's currency, the baht, became overvalued, and investors began to pull out. This sparked a domino effect, causing financial problems in neighboring countries like Indonesia, South Korea, and Malaysia. The crisis had significant macroeconomic level effects, including sharp reductions in the values of currencies, stock markets, and other asset prices of several Asian countries. The nominal US dollar GDP of ASEAN fell by $9 billion in 1997 and $218 billion in 1998. In South Korea, the $170 billion fall in 1998 was equal to 33% of the 1997 GDP. Many businesses collapsed, and, as a consequence, millions of people fell below the poverty line in 1997 to 1998. Indonesia, South Korea, and Thailand were the countries most affected by the crisis. There were a number of factors that contributed to the Asian financial crisis, including overborrowing by corporations and banks. Many corporations and banks in Asia had borrowed heavily in foreign currencies, particularly US dollars. This made them vulnerable to changes in the value of their currencies. Speculation in the stock market. There was a lot of speculation in the stock markets of Asia in the years leading up to the crisis. This led to inflated stock prices, which were then vulnerable to a crash. Loss of confidence in the financial system. When the crisis began, there was a loss of confidence in the financial systems of Asia. This led to a decline in lending and investment, which further exacerbated the crisis. The Asian financial crisis had a significant impact on the economies of Asia, which led to a decline in economic growth, an increase in unemployment, and a decline in living standards. The crisis also had a negative impact on the global economy. That led to a decline in trade and investment, and it contributed to the slowdown in economic growth of the United States and Europe. The dot-com bubble burst of 2000. The dot-com bubble was a period of rapid economic growth and inflated stock prices in the United States, primarily driven by the rise of internet-based companies. The bubble began in the late 1990s and peaked in March 2000, when the Nasdaq Composite Index reached a high of 5,048. The bubble burst soon after, and the Nasdaq lost over 75% of its value by October 2002. Companies that had been valued in the billions of dollars just a few months earlier were suddenly worth next to nothing. Investors lost their money, and employees of these companies found themselves out of a job. Many of these dot-com companies were based on nothing more than an idea and a flashy website. They had no real business plan, no revenue stream, and no way of making money in the long term, but investors were so caught up in the hype that they didn't bother to look at the fundamentals. There were a number of factors that contributed to the dot-com bubble, including low interest rates. The Federal Reserve kept interest rates low in the late 1990s, which made it easier for people to borrow money and invest in stocks. Easy access to capital. Venture capitalists and other investors were eager to invest in internet-based companies, even those with no track record of profitability. Exaggerated expectations. Many investors were convinced that the internet would revolutionize the economy and that internet-based companies would become the next big thing. The dot-com bubble burst when investors began to realize that many of the internet-based companies were not profitable and that their stock prices were based on unrealistic expectations. This led to a wave of selling, which caused the stock market to crash. The dot-com bubble burst had a significant impact on the U.S. economy. It led to a decline in economic growth, an increase in unemployment, and a decline in living standards. It also had a negative impact on the global economy. It led to a decline in trade and investment, and it contributed to the slowdown in economic growth of other countries. The global financial crisis of 2008. The global financial crisis of 2008 was a severe worldwide economic crisis that developed in 2007 and became more severe in 2008. It was the most serious financial crisis since the Great Depression of the 1930s. The crisis was caused by a number of factors, including subprime lending and the housing bubble. Subprime lending is the practice of lending money to borrowers with poor credit histories. This type of lending became widespread in the United States in the early 2000s. The housing bubble was a period of rapid increase in housing prices in the United States. This bubble was fueled by subprime lending and easy access to credit. People were buying homes left and right, even if they couldn't afford them. Banks were more than happy to lend them the money because they could make a quick profit by selling those mortgages to investors. These investors then bundled those mortgages into securities that were sold to other investors. The housing bubble burst in 2007, which led to a decline in housing prices and a wave of foreclosures. People couldn't afford their mortgages, and they started defaulting in droves. Investors realized that those securities they had bought were now worthless. Banks started going under, and the economy started to spiral out of control. Banks were also lending money to each other during the housing bubble. through the interbank market to meet their reserve requirements. When the housing market crashed, banks started getting nervous. They didn't know who was holding all those worthless securities, and they didn't want to lend money to each other anymore. The interbank market froze up, and banks started going under. When the economy started to spiral out of control, the government stepped in and passed the Troubled Asset Relief Program, TARP, which gave banks billions of dollars to try to stabilize their operations. They also passed the American Recovery and Reinvestment Act, ARRA, which injected money into the economy to try to jumpstart it again. The financial crisis of 2008 had a significant impact on the global economy. It led to a decline in economic growth, an increase in unemployment, and a decline in living standards. The crisis also had a negative impact on the global financial system. That led to a decline in lending and investment, and that also contributed to the slowdown in economic growth of other countries. The flash crash of 2010. The 2010 flash crash was a major stock market crash that occurred on May 6, 2010. It was the largest one-day percentage decline in stock market history since Black Monday. The Dow Jones Industrial Average, DJIA, lost over 9% of its value in just minutes, before recovering most of its losses by the end of the day. The crash was caused by a number of factors, including a sell-off in the stock market. The stock market had been on a downward trend in the weeks leading up to the crash. This trend was exacerbated by concerns about the European debt crisis and the global economic slowdown. A large sell order. A large sell order for SP 500 futures contracts was placed, which triggered a wave of selling that led to a sharp decline in stock prices. The use of high-frequency trading. High-frequency trading is a type of trading that uses computers to buy and sell stocks very quickly. This type of trading can amplify market volatility, as it can lead to large orders being placed very quickly. The flash crash had a significant impact on the stock market and the global economy, that led to a decline in investor confidence and a slowdown in economic growth. The crash also led to calls for regulation of high-frequency trading. The China stock market crash of 2015. The 2015 China stock market crash was a period of sharp decline in the Chinese stock market that began in June 2015 and ended in early February 2016. The China Shanghai Composite Index lost nearly 40% of its value in just a few months. The crash was triggered by a combination of factors, including a slowdown in China's economic growth, a decrease in exports, concerns about the country's currency, overspeculation, and loss of confidence in the financial system. Investors who had poured money into Chinese stocks were left with huge losses, and many were forced to sell off their assets to cover their losses. The Chinese government intervened in the stock market in an attempt to stop the crash. This intervention included buying stocks, lowering interest rates, and providing liquidity to the market. The China stock market crash had a significant impact on the Chinese economy, which led to a decline in economic growth, an increase in unemployment, and a decline in living standards. The crash also had a negative impact on the global economy, that led to a decline in trade and investment, and it contributed to the slowdown in economic growth of other countries. The COVID-19 market crash. The COVID-19 pandemic took a toll on the global economy, and the stock market had not been spared. The COVID COVID-19 crash of 2020 was a period of sharp decline in stock markets around the world that began in February 2020 and ended in April 2020. Investors saw their portfolios shrink as the stock market crashed. The pandemic caused widespread panic and uncertainty, leading to a decline in consumer spending. This directly affected the stock market, with many companies experiencing a decrease in sales and revenue. As a result, stock prices fell, and investors suffered losses. The crash was caused by a number of factors, including the COVID-19 pandemic. The COVID-19 pandemic was a global health crisis that led to widespread economic disruption. The pandemic caused businesses to close, people to lose their jobs, and consumers to cut back on spending. This led to a decline in demand for goods and services, which in turn led to a decline in economic growth. Fear and uncertainty. The COVID-19 pandemic caused a great deal of fear and uncertainty among investors. This led to a decline in investor confidence, which made investors more likely to sell stocks. The COVID-19 crash of 2020 had a significant impact on the global economy that led to a decline in economic growth, an increase in unemployment, and a decline in living standards. The crash also had a negative impact on the global financial system, which led to a decline in lending and investment, and it contributed to the slowdown in economic growth of other countries. Conclusion. These are just a few examples of the major stock market crashes that have occurred throughout history. While they can be devastating, they also serve as a reminder of the risks associated with investing in the stock market. Thank you for watching. Hope to see you all on the next one.